Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
There was this headline that jumped out at me the moment I saw it. It was a big take from our colleagues Denitsa, Tsekova, and Vildana Hajric. It describes something called a quick buck ETF, and that immediately made me go, we got to talk to them and a character in the story. But, set the table for us. What is a quick buck ETF, according to Eric Balchunas?
Well, look, over the years, there's been a sort of movement to launch kind of unusual products, try to get very creative for the ETF industry. Why? The core of the portfolio, a lot of people go to like cheap index funds, and you can't really compete there. What are you going to do? Launch like a 2 basis point S&P 500? Like Vanguard and BlackRock own the core. So what a lot of issuers are doing is trying to innovate their way to something different and new. Some are innovating on the buffer side to sort of ease worry for older investors. And some are innovating to try to appeal to younger investors and retail investors who may favor income over total returns, or in some cases, a lot of leverage. We call it packaged adrenaline. So on that front, we have this, sort of phrase we call hot sauce. And there's like 6 different flavors of hot sauce. And one of them are these, I call them Yield Boost. That's the brand name of one of them. But the Yield Boosters, this one firm went from like no money at the beginning of the year to like $4 billion. And every product has inflows. And they just write call options barely out of the money. So you give up almost all your upside, but you get a giant fat yield. So some of them yield over 100%. So it's just another example of how the ETF industry is a big tent serving many different people. And this is one sort of evolution in what I call the hot sauce bucket.
We're going to be speaking with Denitsa and Vildana, our cross-asset reporters with Bloomberg News, as well as one of their sources, Todd Akin. You can find him on YouTube at Unconventional Wealth Ideas. This time on Trillions, quick buck ETFs. Denitsa, Vildana, Todd, welcome to Trillions.
Thanks for having me.
Thanks for having us.
Thanks for having us.
Okay, Denitsa, I want to start with you. How did you spot what became this story?
Well, we look at Reddit and we look at one of the firms, YieldMax, which Eric mentioned earlier, and it already had 10,000 Redditors tweeting about it every day, talking about it every day. And then we looked at the inflows and the growth was incredible. Just to give you an example, their first ETFs was just 2 years ago. And this year they launched nearly 20 products. Anything you can imagine. They have single stock products. They have inverse single stock products that generate income. And then we realized that there is a much broader universe there. First, they charge higher than average fees. We often see fees in the range of 1% in those products. So we saw a lot of new issuers being part of that movement. We looked at the data and actually at the broader universe of derivatives enhanced product. We saw over 160 launches, which is a record high. We looked at the assets under management, and it's just the growth is so rapid. It reached 300 billion, and just 5 years ago it was like 50 billion. So the more you looked into the space, the more you found the social media marketing, the long YouTube videos, like a whole universe of people that engage into this community daily, that call it a yield community, that, there are hundreds of products they talk about and compare and discuss. So it's really something that's been growing by the day. We run the data at the beginning of the story and we pretty much had to update it every day because there were so many launches coming. Some of them had like 25 products in them. So it's just like insane amount of products that are coming to the market at a very rapid pace.
Okay, Vildana, tell us more about what the products are and what an investor might hope to accomplish with them.
So as Denitsa mentioned, there's more than 160 new ones just so far this year, which is a record high for the number of new, we call them in the story, derivatives enhanced exchange traded funds. You can divide them, as Eric does, into a number of different categories. We focused on 2 main categories in the story. One is the ones that have like the options overlays that then have these hefty yields, these hefty payouts. And another one is the single stock version. So those are levered or inverse funds that focus on just one company. One of the most popular ones is based on NVIDIA, no surprise, this year. And we mentioned in the story, its assets grew from like 200 million at the start of the year to $5 billion currently. So just a tremendous amount of money is going towards anything that can sort of catch people's attention these days. Obviously, the NVIDIA one is actually a really good example because NVIDIA has been, the stock itself has been doing so well. And so then what people do is turn towards some of these ETFs that can, amp up these returns and just juice things up even further and make things more exciting.
And a lot of the launches are because you got to cover all these stocks. So there's going to be like dozens and dozens of these over the years. I think Granite Shares has a filing to do this sort of yield boosting. I think their firm is called Yield Boost.
Yield Boost,
right?
Yes, correct.
And they're going to do like 3XQ's yield boost. So they're going to do yield boosting on something already really boosted. And I also noticed something funny about this. In Canada, there's an issuer called Yield Maximizer.
Oh, yeah.
And their product line, it was yield in all caps, but then Maximizer was in capital M and then lowercase.
Yeah.
And they had an official name change for all their funds. And normally when you see that, the name changes dramatically or substantially. They just wanted to capitalize Maximizer. Wow. So they and that's when I got a feeling that there's this like sort of race to package and push the envelope. I think of that Top Gun meme, Need for Speed. There is just a market for volatility, big numbers, and it's largely retail traders who are looking for this.
Okay, speaking of retail traders, I'm going to bring Todd Akin in here. Todd, you are a retail trader and you have a growing YouTube channel. Talk to us about how you got into this specific type of ETF.
Yeah, well, thanks for having me, everyone, once again. And well, when I started Unconventional Wealth Ideas, I was investing in the more traditional kinds of ETFs, and then subscribers would bring YieldMax and these other ideas to me. And then I realized that not only is it a way to get more attention of my videos, but I thought, well, maybe there's a way to actually make this investment viable and work for everyone. And so it doesn't really work for others because they don't really play them right. But if you use them properly and you blend them with other ETFs that give you the growth so you don't have as much NAV decay, then you can kind of get an overall blend of ETFs that help you outperform the market.
Talk to us about the specific products that you've used and what kind of experience you've had.
Yeah, well, the first ETFs that came out were Tesla and, the more popular stocks that everyone trades, Tesla, NVIDIA. So we had Tesla and NVIDIA, and Tesla was struggling with its stock price. So Tesla was not liked by many people in the community. They kept saying the NAV erosion is so bad, and how are you ever going to get back to even on this, with this investment? But I'm always from the camp that if you hold your dividends long enough, you'll eventually cash flow. But the key with Tesla is that you can't live out of it, because if you're trying to live out of Tesla and live free from your 9 to 5 with things like Tesla, well, that obviously has too much volatility. It drops. It can be a widowmaker in your account by itself. And so, you don't want to have too much stock exposure anyway with any one stock. You want to stay with the indexes. So Tesla just had bad luck, and its share price was down. So Tesla was not a favorite for others. But if you hold it long enough, you'll come out on top, if you hold it long enough. And so that's my belief is we'll cash flow eventually. But in the meantime, how can you still get performance and not only outperform the markets, but withdraw freely out of your account without it cannibalizing your account? So we combine it with other YieldMax ETFs that actually grow. Some other YieldMax stocks have been doing well. NVIDIA was doing well. It was moving upward, left or right on its chart. So even though it had a huge dividend, you're still getting some growth. So people were really happy with NVIDIA, not happy with Tesla. And I just started, diversifying my portfolio out with the, Amazons, Apples of the world through YieldMax. And then they came out with their fund of funds, which helped give a little bit more diversification and stability with volatility. But still, that wasn't quite enough to live out of your account with. You have to combine it with some of these other funds that have come, out to the market now. Like, y'all mentioned Yield Boost. There's also Defiance and Rec Shares and stuff like that, which all help balance out your portfolio a little bit better.
Mm-hmm. And I think something that Todd also mentioned, there is such a wide variety of products. And we talked a lot about the smaller firms that have been around for just a few years. But for example, one of the biggest products is coming from JP Morgan Asset Management. And during 2022, that product actually worked quite well. There was obviously a massive sell-off. And due to the covered call nature, they managed to outperform the S&P. And asset jumped to 17 billion. I think they kind of tripled in 2022, which, was a year when people were staying away, staying in cash, being careful, and JP got that popularity. So we have those big players actually running some of the biggest product. Now it's 36 billion. Obviously, really, really big ETF. A lot of options, people were writing about it whenever it's rebalancing. So it has its own power and importance in the market. Goldman is also having similar products. A lot of the big issuers are working on them, whether it's buffer, whether it's covered call. They're less likely to engage with retail, even though we've seen some of the portfolio managers like Hamilton Reiner. I've seen a few videos of him on YouTube engaging with some of them, but it's really those mainstream products like YieldMax, like TDAO. They're really encouraging that interaction with retail traders. And something they're saying is that a lot of maybe the big names like JP Morgan and big financial institutions are maybe underestimating retail traders or not going directly to them. So they find this as a way to market and reach a new audience. And indeed, they're seeing big impact from it. After each video they appear, they're saying, oh, we're seeing more inflows after we go on YouTube. So it tells you a lot about how the ETF industry is changing.
JEPI, which is the JP Morgan Equity Premium Income, I would call that more conservative. That's writing call options way out of the money, right? So you get some upside. You get a little income, like 8-9%, as you said. Yeah. Those, I think, are really appealing to older investors, but some younger. One guy on our team, we call him Jeppy Jack. He loves that ETF. Now he likes JEPQ.
Yes.
But I think what the YieldMax and Yield Boost people did is say, oh, that's an interesting idea, but why don't we write calls right here? Or why don't we do a straddle? And this is how the ETF industry progresses. Like the first smart beta ETF was very general. Let's weight by price to earnings or screen by that. And then all of a sudden you get ones that have 25 different criteria now. So when it comes to these ETFs, I want to ask Todd a question about this. If you buy Tesla, TSLY, that's the one that writes call options just out of it. Are you making a call that Tesla won't go up? Because you are giving up a lot of almost all of your upside. So you do get this dividend. So I guess you have to believe Tesla's not going to go on some big run. And then the second thing is dividends are taxed as ordinary income. I was having a conversation with someone that says actually might be more tax efficient to take a stock you've held for a year and just sell small increments of it and almost pretend that's your dividend to be taxed less. What do you think about both those, Todd?
Yeah, well, so they have vehicles that they combine, you can combine with the Tesla to get your upside, like a TSLL. I don't know if that's Granite shares, but y'all were mentioning Yield Boost before. And so there are vehicles that you can use to get your upside. I mean, myself, I will buy a little bit of Tesla stock or sell put options on Tesla to get more upside appreciation and lower my risk a little bit there. And then I'll buy Tesla just for the income. And obviously, my big thing at my channel is I stick with the indexes where Tesla is a large part of, let's say, the NASDAQ. It's a pretty good chunk of it. So I don't mind putting the bulk of my money in things like Cornerstone, which is, like JEPI is one of my one of my favorites. That's a crowd favorite. It's more conservative, but Cornerstone was one of the first ever. They've been around since the 80s, and that's where I get a lot of my performance that's indexed. So I don't have to reach for a Tesla or any stock specific gains. I can put it in something like a Cornerstone, CRF, CLM, and then that gives me not only the index exposure that I need, but it's a very unique fund. It has a 21% dividend at the NAV, and it drips that dividend. It drips the 21% dividend down at NAV for free money every month, as I always say. So it's there's like an 18% premium right now with Cornerstone shares to its net asset value. So when you drip that 21% dividend, you're also getting that premium gain every month, which is really interesting. And I don't know why more people don't discuss Cornerstone. It's 4-star rated on Morningstar, 5 stars sometimes. And so instead of reaching for a Tesla, I go with the indexes, and I go with things that can help me get performance. Cornerstone moves, it has 20% premiums on average, and it has a 20% dividend, and it drips it down at the NAV. So I kind of get my outperformance that way, and then I play it around its rights offerings to really level up my account. But then I have Cornerstone and all these other funds that I mentioned, Rex funds and other funds like that. But as far as the taxes go, Cornerstone is also return of capital. So many of these funds might be a return of capital, but Cornerstone, if you don't sell those shares, you don't have to pay taxes. So that's also how I get around the taxes with, return of capital.
I want to jump in and say, just to be super clear, like a lot of people will consider these investments really, really risky. And Eric, you mentioned that they can trail. A lot of them trail their underlying stock or their underlying index. So, you'll have like the Tesla will just be underperforming by that much more versus Tesla. Even during a year when Tesla is down a lot, it'll be down even more. Same goes for, the Coinbase ones we mentioned in the story and a lot of other ones. For retail investors, for a lot of retail investors, that might not matter. Maybe they're more interested in getting that dividend income and less interested in, maybe it's just not as big of a concern that something is underperforming. They want the dividend income. But I just wanted to caveat that they really are considered, a lot of them are considered risky by, the investment community, people who watch this space.
Yeah, no doubt. I mean, we have our traffic light system. These would be yellow lights. They're not quite red because there's no leverage involved. They're not rolling futures. But you got to really read the fine print here and know what you're doing. I think something like a 2x Tesla, though, that is red light because you could lose money quicker. These are writing call. It's different. Once you add leverage into the mix, then everything could go twice as fast up or down. So I think that's where these are moderately risky, but they're, again, I think, Todd, you seem like you have a plan for this. You like the sort of mixing and the concoction of different things. And this is what you like to do every day. So I think this is the kind of template for like the kind of retail trader. Because remember, Joel, we had that guy on, that 19-year-old who'd love to trade SQQQ and TQQQ. But he monitored all day.
It seems so long ago and quaint.
It
almost.
does seem Well, honestly, that's a lot of volatility, though. That's a whole nother level. I think this is actually tamer. But at some point, I think, Todd, let me ask you this. Like, you have fun trading, you do this stuff. Like, at some point, either you do really well and you stick to it, or maybe you're like, actually, I'll just buy Tesla stock or the Qs and just not mess with this anymore. I do think sometimes traders do come to that, but on the flip, that's not as fun. And this is part of what we call ROE, return on entertainment, because a lot of people have a core 401k, they can't touch it. You got to wait 30 years for it to compound. It's like watching paint dry. Actually, it's like watching a tree grow. You would go mental looking at it every day. So they like to have fun with some stuff on the side. Is that this for you, or is this like your whole nest egg, I guess? And how do you feel about that idea of, do you think you'll someday come out the other end and be like, you know what, I'll just buy the stock and wait 30 years?
Yeah, I appreciate that question, Eric. For me, it is fun to not have FOMO, because when you're in the indexes, you'll see other stocks kind of jump up and you'll say, oh man, I wish I was in that stock. So what Yield Max and some of these funds do for me is they allow me to not have FOMO. I invest a very small amount in these kinds of vehicles like Yield Max. I always say, if I have $100,000 position in this index over here, well, then Yield Max will be like 1,000 or 2,000 of my dollars towards the bottom of my portfolio. They just kind of give a little bit of extra growth. For me, the whole name of the game is qualifying income. And when you mentioned your trader that did SQQQ and TQQQ, I strangle those often, but my thing was the banks didn't let me get my house with those gains. They were too up and down. I needed dividends. So I go with Yield Max and all these other dividend funds to give me the qualifying income I need to get loans and to live free. And if I hold them long enough, again, they'll cash flow. And even though they're down at the moment, they will eventually cash flow eventually. And, I keep them so small to where they don't even affect my performance. They just kind of give me the FOMO that that I can take care of there. And they give me the qualifying income I need to live free from a 9-to-5.
That is interesting. It's a great anecdote, Todd. Thank you.
I'm so curious about that, Todd. So just in general, talk to us about how you approach a portfolio.
Yeah, I mean, every day I say it in my videos to stay with the indexes, and obviously on my about $1 million invested in my account, we're up 32% for the year. Most of that is because I anchor my portfolio to Cornerstone, and then I anchor it next to Defiance, and then Roundhill, because Roundhill gives you some of the gains that move up, upward, left, or right, and you get the dividends. But Cornerstone, I always tout that one because it has the lowest maintenance, which is another term. I don't know if y'all want to get into that on this podcast, but in order to withdraw out of your account, you need to have low maintenance names. And Cornerstone's such high quality that it's low maintenance, whereas a lot of Yield Max names are low quality, so they have high maintenance, so they suck up all of your equity right off the bat. So I tried to stay with low maintenance names that are indexed near the top of my portfolio. Those give me the compounding that I need because it's easier to make 10, if you have $1 million invested, it's easier to make 100,000 on 10%. On a 10% gain than it is to invest 100,000 and expect a double off of 100,000. So I let compounding do a lot of my work for me. It takes care of my taxes because they're return of capital. It takes care of my risk. They minimize my volatility. And then I just keep Yield Max small for the fun, no FOMO, and to just give me a little bit of extra qualifying income that then pays down my margin as well. And then I'm getting extra growth, obviously, by using the margin that we use at my channel.
Yeah, I think it's an interesting point that we discovered during our reporting that a lot of those traders are using those ETFs as part of their personal finances. A lot of people are taking loans. Some of those things are obviously quite risky, but I think a lot of it goes back to the FIRE movement, people generating passive income. So that's definitely a big force we're seeing on these forums, and people very, very excited. But then this goes back to the bigger picture of why this is happening now. And in terms of regulation, there were a lot of changes. There was the ETF rule in 2019, the derivatives rule in 2020. So before that, we really didn't have access to those products. We also saw the single stock ETFs, which have impact both on the covered call. We saw the biggest yields thanks to the single stock ETFs. And we saw the biggest leverage and biggest volatility thanks to those single stock ETF. Kind of wrapping up around here about the fact that what we've seen is something new, something that wasn't available to retail before. Some people are cautious about that. We even spoke to the SEC advocate, and they say they're worried about the growing complexity at a time where retail traders are so active. They're very interested in the space. The space is growing so fast. So perhaps one important point to think about it is those products are often used they have big impact on people's lives if they're taken as a loan. And also, this is something kind of new in terms of access for retail traders.
Movie ratings, Joel. That solves all this. Be like, oh, these are...
Or stoplights.
Yeah, I know.
Yeah.
I wasn't allowed to do it because of copyright. But movie ratings are perfect. It's like, oh, these Yield Maxes, they're PG-13. Okay, why? Well, XYZ, or TSLL, 2X Tesla, that's R. And then there are a few beyond R. We won't go into those. And there's a lot of... How about this?
Name some names.
Double leveraged VIX futures rollers.
Yes, that's definitely.
What about
Sounds like that's a roller coaster.
2X MicroStrategy?
2X MicroStrategy. Well, honestly, you have to have commodity futures rolling. The TVIX was the ultimate because it was an ETN, which has credit risk. It rolled futures, and it was leveraged. Wow. And it was the VIX. It was always going to go down to negative 99.9%. But I'm okay with this, Joel. I feel like this is a big tent. The industry, the wrapper is so malleable that they can really work in a lot of ideas. Some of these are going to solve real life problems. There will be a couple, spots where somebody who doesn't know what they're doing steps into the wrong product. And that sucks. So I think you need ratings. But ultimately, get ready for more of this. I mean, this is not going away. I heard from someone at the SEC, the product's coming in, and not just the yield max, but like the buffer, which are for older people, conservative. Some of those are getting really wonky. And we're going to continue to see a lot of derivative use, but most of it, I think, will be pretty responsible. But there's definitely going to be the fun stuff, Joel. I mean, that's just it's always been this way.
Todd, as somebody who is so intimate with the retail crowd and the advice that you're giving to people on YouTube, curious, like what do you recommend people understand about the fine print in the prospectus while they're considering emulating what you've been able to do?
Absolutely. I completely agree that there's a lot of risk with these types of vehicles. So what I always say is to make sure that you match these vehicles with the percentages that they are in the indexes. So if you have Apple, which is 10% of the NASDAQ, or Microsoft, which is 10%, then I didn't mind having 10% of my portfolio in MSFO. And that was doing really well for us. It was a nice steady gainer, and it was doing well until they had maintenance changes. When they had maintenance changes, that sent shockwaves throughout the communities because some people were prematurely margin called just because of the maintenance change. So I would say to keep them matched at no more than they are as a percentage of what they trade in the indexes. And also, even with that could still be a lot of volatility in your account because you want to stay indexed is what I always say. Keep them. If you're gonna buy these, make sure they're no more than the percentages that they're represented in the indexes, but also just stay indexed, because 90% of traders can't beat the S&P. And so stay indexed, keep these positions small, and make them no more than what they are represented in the indexes.
All right. On that note, we're going to wrap. Denitsa, Vildana, and Todd, thank you so much for joining us on Trillions.
Thank you so much for having me.
Thank you.
Thanks for having us.
And that story, 100% yields are fueling a retail boom in new QuickBook ETFs.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you'd like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.